This is the one that gets a lot of. This is the exception. This is the silver lining that you're all going to find that probably none of you qualify for, but we're going to talk about it anyway. A lot of you have done a bunch of reading. You may have heard of this, and you're dreaming about maybe you can use this because you've got a bunch of losses. And wouldn't it be nice if you didn't have to, if you were able to use those losses indiscriminately? Like my guy with 190 rentals, he has no trouble deducting his losses. Why? Because he's a real estate professional. There's no question about it. More than half your personal services performed in trade or business, that's called your job, must be related to real estate properties, trades or business. That means rentals. That means developers, real estate agents, landlords, of course, and it doesn't include people like mortgage brokers, real estate lawyers, or real estate CPAs. Again, I should have another big frowny face there because I don't get it. Because I'm not a real estate professional, even though I like to think I'm sort of one. And yet you have to perform more than 750 hours in that real estate business. These are, when you got a husband and wife, these two criteria have to be performed by the same person. Okay, so they have to spend more than half their time, and they must spend at least 750 hours doing that. And the IRS is quite a stickler on these numbers. You have to prove it. Okay. Now I have been in fights with agents that say I have to prove it, and I do believe there is a rebuttable presumption, which is find me anything this, like my client with 190 rentals, find me anything this guy's doing that's not real estate. Okay, that's I don't think I have to document it on him. Because, find me something that's not. People in their lives, how many people in your life keep track of your time in a log on a daily basis for everything you do? And then you don't, okay? So it's an impractical obligation that the IRS is trying to impose on you. But if you're going for this exception, you better be doing it. You better be keeping track. What I will tell you is that this is a you have to be very active in real estate. You avoid that passive treatment. Your losses are treated as ordinary losses. There's no limitation, regardless of your income level, giving you major tax savings and your annual income reduction on this. If you're into California real estate where you're not worried about its cash flow, but you're playing the appreciation game while that property is appreciating, and you're absorbing the cash flow losses because you have a highly appreciating piece of real estate. These losses can get tremendous, and if you're playing that game when you're not a real estate professional, the benefit of the losses is lost. But if you're a real estate professional, this can get into really big money. So the folks that I have that have quit their non-real estate day jobs, they're getting a lot of benefit out of this because they're playing the California appreciation game. Again, we went through these criteria. You can get a real estate license. That does give you credibility, but you got to do the work. You have to keep timesheets for your daily activity because the IRS, I have right now 25, I counted them before I came here, I have 25 real estate professionals, active real estate professionals. This is the hard criteria to manage. I have 25 clients that are active real estate professionals. 21 of them have been audited. Okay, and they don't just look at your real estate professional, that's where they start. And they'll probably go away if they get you on real estate professional, but if they don't, then that's just a regular audit and they're going to go after something else too. So I've steered more people away from real estate professional than to it because I think it has to be very obvious for most people.
And so this would mostly be beneficial or apply to somebody that's earning or getting losses of more than $25,000 a year,
or having income that's too high that their losses are now zero. So you just have to be in a loss situation.
So if you think you get a lot of losses, but in some instances with people, lots of rental properties, they might not have a lot of losses, so it might not really outweigh. Or
Right. But again, we'll go back to the statement I made earlier: is I want you all to have positive income. I want your properties to cash flow so good you don't have to worry about these limitations. That's my goal. I like income producing property. I like having income that I have to worry about getting to zero, not what do I do with the losses that I'm racking up because my property doesn't cash flow. All right, let's keep going here. Tax on dispositions, what's tax and what rate? The appreciation is taxed as a capital gain from 15 to 20%, depending upon your income bracket. It used to be 15, now it's up to 20. Thanks to the recent Affordable Care Act income, we've tacked another 5% onto it. Depending upon your level, I think it's $400,000 of taxable income, which is, a Bay Area property. That $400,000 income could come from the property alone. So expected, in the Bay Area, you have your day jobs and you have gains on your rental. Be expecting to pay the 20% bracket on most of that gain. We have depreciation recapture. Remember, I was talking about the depreciation, how you'd have to recapture it. This comes back at a 25% rate, which is a good thing if your tax bracket is above that 25%. Not necessarily a good thing if the whole thing is if your other tax rate is less than 25%, you don't pay this. But most folks in this room are probably at least in the 25% bracket. Anybody above the 25% bracket in their regular income is only going to pay 25% on the depreciation recapture. So let's say you're in the 33% bracket for your regular taxes. You're going to take that depreciation deduction today at 33%. And then years later, when you sell it, you're only going to have to give it back at 25%. We call it good arbitrage. We got a rate break of 8%, and how many years of time between the day we took the deduction and the day we had to pay it back. On the state, we've got some new rules. Most tax at the top rates 9.3%, and now as of the new laws that were passed a couple years ago, these go all the way up to 12.3%. That's a lot. Pay 20% up here. Excuse me. Pay 20% up here. Pay 20% up here. 25% recapture. 9.3 state. State doesn't have a break for capital gain, and if you're selling it in your personal name, you're going to have state withholding tax on California property. So go buy property elsewhere. Other scenarios include 1031 exchanges. Again, somebody will be talking about this. It's a tax-free and highly effective loophole. We have installment sales. You can sell your property over time to a buyer and spread your gain out over a number of years. I'm not particularly crazy about this. I hate being the bank. But with the right scenario, especially when we talked about the Obamacare tax, if you were able to sell on an installment sale and take a little bit of gain every year, you wouldn't get over those limits and you'd save that tax. So there is some incentive to do an installment sale, but you have to have a solid buyer that you trust, that with a property that you have to be willing to take back if they don't pay. And a lot of people think, I'll just foreclose on a property. Well, in California, that's a big deal. Being able to foreclose on a property in California is a really big deal. In other states, foreclosure can happen like that. Nobody's going to get in your way. The process is very quick. For instance, I own some properties in Texas. I own some properties in Tennessee. One of the reasons I picked those two markets is that kind of stuff isn't a problem. There just aren't all the legal impediments in those states that there are to landlords and real estate owners in general. Those impediments don't exist in those states that exist here in California. It makes it very hard they make it very hard to foreclose on a piece of property, especially if you're an investor that has carried notes back. That's very hard to do in California. It can be done, but expect nobody to pay rent for months and months and months and months, and you'll have to carry it. It's going to be an expensive process. But I'm not a lawyer, so I'll stop there. Gains from the sale of tandem property. This is one of my favorites, where we inhabit half of the duplex and use it as our private residence and rent out the other half. You can use the gain on sale exclusion that we all have for the sales of our home up to $500,000, and then you could 1031 exchange out the gain you have on the other side of the duplex. I've seen that. I've seen clients do that. The gain on sale of tandem property can also be used where you used the property as your residence and turned it into a rental. We have the homeowner exclusion goes for, you have to have used the property 2 out of the last 5 years. This is something I'm going to do as I get ready to retire, is I'm going to move into my rental. Okay, I have one rental in particular that I know I'm going to do it because I get a lot of appreciation. It's a California rental. So I have a lot of appreciation, bought a really bought at a really good time, and it's appreciated very nicely. And I'm going to move into that property because I don't want to pay the capital gains on that. I'm going to use that property as my private residence. Now that I'm retired, I'm no longer married. I'm single. My daughter's about ready to move out of the house. I'm going to move into that rental, and I'm going to live in it for 2 years, and then I'm going to sell that rental, and I'm not going to pay any tax because it will have been my house. I don't have $500,000 appreciation, but all the appreciation I do have it, and I'm going to exclude because it was my residence. And if you're in the Bay Area and your exclusion is more than half, more than the $500,000 that you're allowed to exclude as a married couple, if you sell and more than half of your, more than $500,000 you have gain, if you've converted it into a rental, you get to use that rule to exclude $500,000 as private residence, and then you can use a 1031 to get rid of the rest. That's a neat trick. Yes, ma'am.
I understand what you're doing, and I think it's,
Yeah, but a lot of people don't want to live in their rentals. I have one that I would do that.
Oh, yeah, okay. Go to all those other states for a little while.
Yes.
2 years.
Yes, you could do that. Yes, we call that serial sale.
Yeah. Wasn't there a change in the rules of?
Oh, that has to do with the property. Yes, there was a change in the rules recently where once you do an exchange into another piece of property, you will have first of all, you can only do this, you can only use one sale exclusion every 2 years. Okay, that's an important distinction. You only use one sale exclusion every 2 years. So you can't do this more frequently than 2 years. And remember, you had been in that house using it as your private residence for 2 years, so you need 2 years to qualify for it anyway. All right, but you can't use this 2 out of 5 rule for a property that you got into with an exchange. So if you got into a rental, you can't use this technique if you've acquired that property as a rental using a 1031 exchange within the last 5 years. That's the exception that you're looking for.